Hello everyone, and welcome to today's financial report. Let's start with the big picture. Today's global markets did not move in one direction. Instead, we saw dramatic divergence across different asset classes. Let's begin with U.S. equities. All three major indices closed modestly higher. The Nasdaq gained 0.16%, the S&P 500 rose 0.21%, and the Dow added 0.22%. More notably, the VIX Volatility Index tumbled 6% to 14.89. That tells us there is no panic inside U.S. equities. Investor sentiment remains relatively stable. But on the other side of the Pacific, Chinese stocks had a rough session. The Shanghai Composite fell 2.4%, the Shenzhen Component dropped 5.01%, and the Chinext Board plunged 6.26%. That is a severe decline by any measure. What makes today particularly interesting is the combination of moves. Safe haven assets rallied. Spot gold surged 3.81% to $45.77 an ounce. The 10-year Treasury yield fell 1.13% to 4.65%. And the US dollar index weakened by 0.82%. Now here is the key point. Safe havens went up, the dollar went down, and yet US stocks still managed to close in positive territory. That tells us capital is not fleeing risk assets altogether. Instead, we are seeing a cross-market rebalancing. Some money left Chinese growth stocks and rotated into gold and dollar assets. Other money stayed put in U.S. tech heavyweights. So today's market is best described as structural divergence, not a systemic risk-off event. Let's walk through the global path today. The Asian session was the main turning point. Chinese equities sold off across the board, with the Chinext index leading the decline. The damage was concentrated in high-valuation growth names. We did not find any macro trigger confirmed by mainstream media, so our working assumption is that profit-taking hit the growth style after a strong run. But without external confirmation, we have to lower our confidence on that call. European data was missing for today, so we are not making any assumptions about capital flows there. The US session, however, was solid. All three indices closed higher, and futures were already pointing up before the open. Nasdaq futures rose 0.36%, S&P futures gained 0.44%, and Dow futures added 0.41%. The VIX dropped 6%. U.S. equities simply absorbed the negative sentiment from Asia without any follow-through selling. That was the stabilizer in today's global capital flow picture. Now let's review our morning report. We called for a range-bound session with divergence. Directionally, that was correct. Markets were not moving in one direction. But the magnitude of today's moves far exceeded our expectations. The A-share decline was much deeper than a normal range-bound day, and gold's rally was also larger than typical. Our biggest miss was this. The dollar was falling, treasury yields were falling, and the yuan was appreciating. Under a conventional framework, all of those factors should have been supportive for Chinese assets. Instead, a shares crashed. That tells us the pricing power in a shares is currently in the hands of domestic sellers, and the market has decoupled from external liquidity conditions. Let's talk about the main capital flows and sector signals. The strongest direction today is gold. We assign a 65% probability that this trend continues. The logic is straightforward. A weaker dollar and falling treasury yields reduce the opportunity cost of holding gold, while safe haven demand adds extra buying pressure. If gold holds above $4,500 tomorrow, we can upgrade this to a confirmed trend. The second strongest direction is U.S. large-cap tech. We give that a 60% probability. The weakest direction by far is the A-share growth style, particularly the Chinext board. With a 6% single-day drop and no policy support in sight, that downtrend could extend. For tomorrow, here are our verifiable predictions. For Asian markets, the Shanghai Composite is likely to open lower and consolidate. The key level to watch is the CSI 300 at 45.50. If that level holds, we see a 55% chance of intraday repair. If it breaks on volume, expect further downside. For gold, we expect high-level consolidation between $4,500 and $4,600 in the Asian session. If the dollar continues to weaken, the probability of an upside breakout is 60%. The invalidation signal would be the dollar index bouncing back above 99.5, or the 10-year yield climbing back above 4.75%. For U.S. equities, we put a 60% probability on Nasdaq futures staying in positive territory. But we need to watch the VIX. If it climbs back above 16, or S&P futures break below 7,700, we switch to defensive mode. On the strategy side, today's recommendation is to control risk while maintaining some long exposure, or to use hedges. Hold core U.S. equity positions, reduce a share-related exposure, and do not make concentrated bets on any single direction. Tomorrow morning, focus on 3 things. First, the capital absorption in the first 30 minutes of a share trading. Second, whether gold can hold above $4,500. Third, whether the VIX stays below 15. If a share stabilize and gold does not fade from its highs, you can add modest exposure to U.S. tech. Conversely, if U.S. futures turn negative, gold drops sharply, and the shares continue falling, if any 2 of those 3 signals appear, the strategy is invalidated and you should move to defense immediately. Our probability assessment for tomorrow is as follows. Up 40%, range-bound 35%, down 25%. Thank you for watching, and we will see you tomorrow.